and Jerry Robinson. Welcome back to Face. How are you, buddy?
Oh, it's great to be here. Thanks, Dale. Nice and early in the morning here.
So it's been a while. It always is when we get back together. Top of mind for you, Jerry, in this environment here.
Well, we're certainly seeing a pullback, and we're certainly perhaps the early stages of what may be a deeper pullback as we move into the notorious month of September.
Okay.
September
it's seasonal.
I believe it's seasonal. I believe that there's some seasonal aspects. We've had such a strong run in the stock market rally. In fact, I can pull up some charts.
Okay, go ahead. I'll stop sharing.
Would you like me to? Okay, let me go ahead and do that. Let me grab this. Yeah, that way we can kind of talk through some of these charts that we're seeing. Let me just refresh here. We'll begin with the S&P 500. We've had such a great rally. It's really been something, one for the books.
It has.
It really has. And the last time you and I were sitting here talking, there were many more bears than there are today. Maybe it's starting to even out, but
I'd say most people are saying, correction. No one's saying the end of the move. I'd say most people are saying just a normal run-of-the-mill correction, maybe 10%.
There you go. Exactly. I mean, take a look at this S&P 500 chart to really get it in focus, and you'll see we haven't even touched the 50 yet. So we haven't touched the 50 SMA since March. We were in this kind of tight grind around the 200-day, which is this yellow line. We were grinding around it. We finally broke free back in March, and then broke out above that key 4275 area, which was hampering us back in August of last year. We got this nice rally right along the 14 EMA, which is usually a nice area. Some people use the 20. I prefer the 14, but really just whatever you use for a short-term MA. But we lost that, and that's usually the first sign, that we're going to see something perhaps deeper. And then you get to the 50, and right now we haven't touched it. So it's very possible that what we have here is a pullback to this 50, a negotiation with it, and then a rebound. That's one scenario. Another scenario is that we come down on the S&P from where we are now, 4467 or so. We lose 50, and we come back to this key support area of 4275. That probably is perhaps more likely. And then, of course, a pullback all the way back to the 200-day would probably be unjustified, I would assume, based upon everything that I'm seeing. So we're of the opinion that 4275 probably going to serve as the area where we get the a bounce. In fact, I'm trying to clear my charts here. How do I clear? Let me see. Clear all drawings. There we go. Perfect.
Okay. So what about yields, Jerry? The bonds, TLT, you have a view on them. People keep bringing up record short positions by large specs, and they've said that for a month, yet yields kept going higher. But today may be a different story, but I'm wondering what your view is on yields here.
Well, I think part of it will be determined by Thursday's CPI print. So that is, actually, here we are this morning, which I guess we're going to have it. We just got it. Okay. I haven't even seen it. What was the number there? Let me go double check it, because that would really.
I forgot the number, but yields came down.
They came down. Okay. That's good. We were watching for that number this morning. The CPI rose 3.2% from a year ago in July, less than expected. 3.3% was what they were pretty much focused upon. So it's a little slightly, of course, we'll get the PPI numbers tomorrow, and that'll also help us. But
NASDAQ on the 50 compared to S&P. So NASDAQ led the way up. NASDAQ's leading this pullback.
Absolutely. Yeah, we've seen the weakness in tech. We've seen, in fact, for a long time, tech was the big winner for the year. We've since seen it replaced by communications. In fact, let me pull up one other thing that I want to show on the screen here before we get back to the charts. This is the Robinson report. So this is something we put out each weekend for our members. And when we come down, there's a couple of interesting things here. The first one is just the year-to-date gains as of the weekend. So, Bitcoin is the big winner year-to-date, of course, if we're looking at the 10 major markets that we track right here: Bitcoin, Ethereum, NASDAQ, S&P, Russell 2000, crude oil, gold, dollar, China, and silver. Yeah. Silver's the big laggard for the year, the only down market as of the weekend. Bitcoin, rip roaring 75%, Ethereum up 52%, and the NASDAQ 40%. So again, any kind of pullback in this environment on the NASDAQ, is probably healthy at this point. I mean, after a 40% run. Let me show you one other thing too.
Do you like NVIDIA and Apple?
Absolutely. Those are two of our largest holdings. Absolutely. Yeah. Those.
It doesn't bother you that Apple gapped its 50-day moving average?
Well, I have a 10 plus year time horizon on the holding, so it's not a trade. Okay. So yeah, I consider
you buy more at 115.
I buy more. Oh yeah, I buy more.
At 115, not 150.
I have a chart on Apple. Let me just pull that one up, because that might be instructive on that topic. Let me see if I have that Apple chart handy here. I'm not seeing it. Oh, well, maybe that's it. Oh, here it is. Here it is. Yeah, this is kind of a little bit of a sloppy chart. I'll show you where we consider the long-term opportunity zone.
Yeah.
Here it is. Okay, here it comes. Again, a sloppy chart. I haven't updated it in a little bit, but here's this long-term opportunity zone, as you can see right there, right below that 200 right now, but it's right in between 120 and 90. We didn't enter it in the beginning of 2023. I was hoping for that opportunity. We didn't. Anything in this zone here for us is just, a gift. And I don't suspect we'll see it anytime soon. But again, look at Apple. This is a weekly chart, so you're not really seeing the 50-day, but we're miles above the 50 weekly, and of course, as well as the 200 weekly. So we've had a really big rally there. Now, on the sector side, communications overtook tech, and consumer discretionary. These three, as you know, have been leading the whole rally all year long. We finally started to see it move into other things like industrials, which has been been in fourth place for much of the year. Basic materials been fighting for that fifth place all year long. Utilities and healthcare are the place not to be apparently right now. But although from a long-term perspective, those are pretty attractive. Energy's really starting to pick up in July, where we started seeing oil prices spike on fears of tightening demand, tightening supplies, Saudis cutting their projected output, Russians, kind of joining them. And so we do expect energy stocks to probably continue pushing higher through the end of the year. And then real estate, of course, we think is another great attractive space for long term. There's so much turmoil there. But
what do you think about what's happening with the banks, Jerry? I mean, you look at the whole picture.
Yeah.
Do you think we have a banking crisis here in the U.S. and that there might be kind of an end game to create distrust of the banks and create enough fear so that the public will embrace CBDC as a savior?
Interesting. That's an interesting way to put it. That's not necessarily what I'm thinking. When I look at the banks, I see this as kind of a big consolidation opportunity for the big banks. I think the big banks are excited about the regional bank fears.
Citicorp, look at that chart. It looks as bad as the regionals.
Well, Citicorp. It may be. In fact, we can look at that. But let me just type it in so we can.
Anyway,
see.
I'm just wondering what you think of the Fed. So I mean, after this number, maybe they're taking a hike off the table in September, but I don't think they're through. And I think this whole CBDC thing is a takeover of the Treasury by the Fed.
Yeah, I can see your point. But in many ways, the CBDC is already here with FedNow, with the FedNow payment system. In many ways, our dollar is already digital. I'm opposed, of course, to the controls that the CBDC would have. I mean, quite frankly, Dale, I mean, in my book, Bankruptcy of Our Nation, I call the Federal Reserve a fraud. I mean, it's
Jekyll
not something.
Island stuff.
Yeah, of course. Yeah, it's
Yeah.
a terrible thing that we've kind of handed over our monetary sovereignty to this entity. And then, of course, the CBDC doesn't make it better. It makes it worse. But when it comes to the banks, the big banks, I think, are excited about the regional banks' fears, and they're benefiting from it, obviously. And so,
not Citi.
well, maybe not. Maybe not their stock price right this second. But what I mean is that over time, they're going to benefit.
They're gobbling them up.
Yeah, exactly. They're gobbling them up. And but as far as the banks, I don't tend to invest in the financials. The only thing that comes close to a financial for me that I invest in would be Visa. And I think Visa is well positioned. But again, you could flip a coin with MasterCard or Visa. I think either one, is going to do fine over time. They're staying out ahead of all this. But yeah, as far as the banks go, I don't tend to invest in them. I do monitor them for our members. Now, when we turn to something like gold's been holding up a lot better than silver.
Yes.
Gold
silver ratio.
Yeah. Oh yeah. And gold has been looking pretty darn good. There's that gold silver ratio, still favoring silver and even heading in that direction. There was I think we were talking about this last time with gold, that we saw just from a technical perspective, for those who like to do technicals like we do, there's this interesting, let's see, where's my pen here? There we go. There's this interesting phenomenon that happens on charts. I'm sure many of your listeners are familiar with, but this is often a really helpful tool where you get these long wicks, especially like on a weekly chart. And those long upper wicks will show a rejection of higher prices. You see it here. We get this really long wick, and then the body is way down here. Well, that's kind of a sign that it's rejecting those higher prices. Likewise, whenever you see a long wick on the bottom right here, well, that's kind of indicating that you're probably going to move higher. They're rejecting lower prices. There you go again, long wicks on the bottom, and then indicating very likely we're going up. And then, of course, when we get up here, we started seeing these long wicks to the upside around 2000. So we said, well, this looks like it's going to reject higher prices. We came down, and then we got a little rejection of this around 1900. We've really held 1900 well. If we're just bobbing back and forth now between 2K and 1900 on the price of gold, it's holding up, as I mentioned, better than silver. When we look at silver, it's down here. Let me bring it down there. We'll get to the dollar in a second. I just want to look at the silver chart real quick. Where is it at? Silver. There we go. So, this one looks a lot worse. We just lost the 200 SMA, of course, on silver for those who follow silver. This one has just had a tough time overall. It's still in a bullish channel. I mean, overall, we have this nice bullish channel that's going on silver. $22 is a major line in the sand. But this 2450 resistance overhead, this 200-day moving average, the 2330 support has now turned into resistance. The one moving average that we use consistently with silver on a daily chart is the 30 SMA. We've been using that one for years. It's a really interesting indicator on silver. So we do watch it very closely. We just lost it as well. So silver breaking down, you can only assume that has to do with recession fears. It's very difficult to know what people are thinking, Dale. I mean, I've been doing this a long time, and we have $5.5 trillion of money on the sidelines. We have hedge funds acting like it's Armageddon, but then you look at the bigger asset managers, and they're seeing blue skies. So
a lot of conflicting things.
A lot of conflicting things, right?
And then does your head ever explode?
Right. Well, sometimes you wonder, but yeah. So it is a little, and for the average bear out there who doesn't look at this stuff all the time, I mean, I would imagine they're very confused as to what's going on, and I wouldn't blame them whatsoever. Now, the dollar is also very instructive. We have a dollar chart here. Let me come back up. Sorry for the headache if it's this zooming, moving.
It's okay. I took a Dramamine.
So the dollar, this one really tells a story. I like this chart.
What, the false breakdown and then back above it?
Well, but also just the lower highs that are just consistently happening here. We got a real bearish channel here. So the dollar keeps kind of faking us out. It'll go down, 2 steps, and then it'll come back 1 step. And that really, this right here really tells the story of what we've been going through over the last several months and pretty much all year, is that things
But
are getting,
Jerry, when you
yeah,
admit when we
yeah,
took out that 101 dotted line,
yeah.
that it looked like a breakdown and people
Hmm.
were coming up with all kinds of downside targets based upon a breakdown of that triangle. That's how you could get 85, because there's a 1400 point
Yes,
formation. And
yes.
then within a matter of days, we have a breakout failure back above your red dotted line. I think there's still a lot of more dollar bears out there than dollar bulls.
So,
Wouldn't you say?
so many, so many.
Yeah,
And the
they
200
could
day
still get
now,
squeezed.
uh, yeah, yeah, that's true.
How
But they
about
have
up
a,
towards your upper red line?
yeah, these are the areas that I would say if we really get a rip roaring dollar rally, which again, I'm trying to imagine what this would look like or how it would happen. You would have to have something that comes out of the blue, because right now the path of least resistance is this bearish channel. I mean, we're
Yeah.
really kind of moving in this, but to really get escape velocity on the dollar, you would need some sort of material change. And I don't know what that would be, but the 200-day moving average would be a bear to get past. As you can see, we haven't been past it since we lost it. We
Yeah.
haven't even
Where does
tested
it
it.
come in? 3.5?
Yeah, yeah, about
Oh,
one and
yeah.
yeah, 103.50. And then,
Okay.
the key area, of course, is a sloppy chart. I haven't updated in a few days, but as you can
I like
see,
it. Yeah.
yeah, but you
Nice.
can see that this key area up here, I mean,
Yeah.
this
That'd be a
this would be
natural.
the that would be the extreme upside that we could possibly see that on some
Okay.
sort of rally. But we don't see that happening.
Okay.
In fact, what we see is quite the opposite. What we expect, let me get back to where I can, there we go. What we see is this dollar coming back down to where it was back in the 2018
Okay.
area, about 88 or so over
Yeah.
time. And the reason for that is because, currently interest rates are what, 5.5% or whatever, the Fed rate. And this is the actual historical rate that we've seen throughout history. This is what we normally see. 5.67% is the average Fed funds rate going back for 30 years. So we're kind of right there at the average. Now, it doesn't feel average to the average person because they're thinking, wow, this is really high. We've had low rates for a long time. But now we're back at 5.5%. Well, clearly that 5.5%, give or take a little bit, is hurting people. It's hurting business. It's hurting the government. It's hurting consumers. And the Fed has one button, and that button is lower and raise. So it's a switch. And so they've raised their interest rates, and they want to lower rates. I mean, they definitely want to lower rates. It takes them out of the focus. It takes them from having to take the blame. They want to get out of the picture. They'd like to start lowering rates. You get the sense that investors already know this, and this is why markets have been rising, because markets are usually forecasting 6 months ahead. We suspect, as you had pointed out, that we're probably not going to see another rate hike. That lag effect as well has to be stated. For those unfamiliar with the lag effect on the Federal Reserve, when the Federal Reserve acts, when it makes a move, when it raises interest rates, you may not see anything for a while, and you may not know what the full effect of that single rate hike is going to be until months in the future. So when they raised the way they did so aggressively last year, we're still seeing the impacts, and we may not know the impacts fully for another few months. And the Fed knows this. And the Fed also knows that when it starts to cut rates, it's not going to immediately help. It's not going to immediately help. It's not going to immediately change everything. There's going to be a lag effect to it as well. So they've got this timing with this lag effect that they're trying to manage like a tight wire. And so I believe they're going to start cutting earlier rather than later. So I could envision, this may sound strange, but I could envision the very first rate cut in September. Now, I'm not saying it's going to happen. I'm saying, as we've been saying, as early as September, they could offer the very first rate cut or language that indicates that they're getting ready to move into it. So either A, a material rate cut in September, or B, some sort of softening of the language that allows the investor to realize, okay, we've really reached the terminal rate. But by December, Dale, I would suspect that we will have the first rate cut in our hands. It may boost a Santa Claus
because
rally or
the
something.
unions are having their way, Jerry, with corporations. Yeah, we're having major wage increases. I mean, even Social Security, the COLA went up.
Yes,
That's pretty ingrained. So, um, yeah, grains. So you could have commodity prices fall, but you get a wage price spiral going, and the Fed isn't
sure.
done. And all the unions are, you don't see any strikes, do you? They're all settled, and they're
Right.
all going, not Hollywood yet, but I mean, industrial America. They're they're giving unions what they want. So
Yes.
that's inflationary.
Indeed. Indeed, which builds the case for keeping rates higher longer,
Right.
and there's a case to be made for that.
So
I'm
why
just
would
a
they pivot with the S&P only, 5% off all-time highs? Don't you think it would take more of a financial emergency and much lower numbers in equities for the Fed not to pause, but to actually reverse and start easing? Why
if they
should they
learn
do it up here?
uh, if they learn nothing from history, you may be right. If they learn that they usually are they lack good timing, then you would be right. I mean, I think whenever when we look back at the rate hike campaign of 2022, many people try to figure out why was the inflation in 2022 and not say in 2021, or why did we not see it in 2020? Why did it start soaring in 2022? Well, this goes back to the whole lag effect. This goes back to the whole idea that you could do you could implement some sort of policy, but it doesn't stream down to the whole economy for months and months and months. This is why it's pretty unfortunate for President Biden. And again, I hate politics. I'm apolitical. I don't care who you vote for. Anybody listening, I don't care who you vote for. You vote for whoever you think. But I think it's unfortunate for Mr. Biden because if you look back at 2020, we had more money printed in the month of June than all of the money that was printed before that from the beginning of time, maybe from the beginning of the time of the United States, 1776 to whenever. So there was a tremendous amount of money printed in 2020. Okay, but it takes a minute. That money just doesn't immediately go out to where it's going to be. It takes a minute to really flow through the economy. And so by the time we get a year later, you're really starting to see wow. And then of course you got supply chain constraints, and you've got a Ukraine war, and you got all these other things. Well, you're simply, and then of course you have the energy cycle, which really tends to peak right before the bear market, and we got all of that, and so now the Fed played late. It should have got ahead of it. It should have known that it was coming after printing all of this money, and they didn't. They didn't do it until sometime in 2022. Then they start raising rates, and they're raising them at a pittance. 25 basis points here, 50 basis points here, and you're thinking, okay, well they've got to get ahead of this. Well, they didn't. It took them a minute, and now they finally got to a place where now inflation is lower than the Fed fund rate. Well, that's where they feel comfortable there, and as long as that inflation rate, typically they'll look at the PCE, but oftentimes even the headline rate. They want that headline rate below the Fed funds rate, and right now it is. And so, as long as that stays that way, you would expect they'll lower rates as long as that headline rate is staying below their Fed funds rate. So I guess what I'm saying is that over time, they really need to get out ahead if they're wanting to drive down rates, and if they want to start easing. Well, they can't wait till we have financial Armageddon on the scene. They've got to get ahead of it, and I think they know that.
Yeah, Jamie Dimon said in a recent interview that Powell needs to take another look at his models. Pretty
Right.
smart guy. So
Yeah.
best way for people to follow your great technical work and how you marry fundamentals with it and work
Absolutely.
with people in your community, buddy.
Absolutely, Dale. Thank you. Followthemoney.com. We've been here since 2010, helping people
Wow.
all over the world just provide,
That's staying power in this business.
Yeah, thank you. Yeah, thank you. We've been here for a long time. And we plan on staying here for a long time. We have a lot of members around the world. They get a weekend report we put out with a video, kind of wrapping up the market, providing great ideas, trading ideas, and investing ideas. We do a live webcast every Tuesday for our members. That is an hour long, just lots of great information for investors and traders. And we have a free podcast. All of it. Followthemoney.com. They can find out more information there, and they can begin by just signing up for our free newsletter right here on the front page.
Great, Jerry. Well, my trading warrior brother, I hope you have the rest of the summer, which, still about 6 weeks, great trading season, and look forward to catching up with you in the fall. And we'll see if the Fed is easing by then.
I totally agree. And I want to say something to you real quick, if you'll let me just for a second.
Yeah, sure.
I've been following your Twitter a little bit, and I just want to say I want to thank you. You've been inspiring to me because you have been so bold in your witness for our Lord Jesus Christ. I mean, I've just got to say, as I've seen some of your tweets, it's almost like God drops them in my lap, Dale. I was just the other day. I just want to encourage you in that. Because I was on Twitter. I rarely get on Twitter to dilly-dally. But I got on there, and the very first tweet was Dale Pinkert. And it was talking about, how God calls and how you're equipped and you have everything you need for your calling. And it was just a word in due season. It was a really great moment. And I was like, wow, Dale, what a guy. I mean, what a guy to remind his audience about the important things in life, that it's not about money, that it's not about all these things. Obviously, we want to be good stewards of what we have. But I love how you front load that. By the way, for those who are, if you're into that, you may not know this, Dale, but we have a ministry, and it's called TrueRichesRadio.com. I've been running that since 2010 as well, and it's all about the Bible and about it's a different kind of approach, more of a kind of a nonviolent love of friends and enemies that Jesus displayed. So
Joseph is my idol, is the best commodity trader of all time. Right?
That's a good one. That's a good one. Well, that's right.
And you know what, Jerry, I like to encourage people, and those are mainly Joel Osteen's prayers that I posted
I see.
there. But thank you. And I've said I'd rather lose followers to be one.
Oh, thank you for not being bashful. Thank you for not
buddy.
being bashful.
All right, bro.
All righty.
Jerry Thanks Robinson, my trading warrior brother, and brother in even higher ways.
Amen, brother.
All right. Nice talking to you, Jerry. I'll be in touch with you.
Okay. See you soon.
All right. Adios. So that's a wrap, everybody. And yeah, check Jerry out at Follow the Money. What a great name. A lot of people appreciate what you had to say, Jerry, and check out he's got a good feel for the macro in the markets, and could join the team in about 14 minutes on the Morning Edge. And we'll wrap it up all tomorrow for you guys. TGIF. Good luck the rest of the day. Good hunting, and don't just count your pips, count your blessings. You're very welcome, AJ. And thanks again, Jerry Robinson. Follow him at Follow the Money, FTM, at FTM. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.